It's only confusing if you don't take the time to educate yourself and to create a plan and to really surround yourself with other people who are doing it. A lot of us say to ourselves, well, Dan's doing it and Gino's doing it. I can't do it. That's nonsense. It's you think you can't do it, and then there's the fear, and then the fear just holds you back or locks you up.
Welcome back to the Keeping It Real Estate Show. I'm your co-host, Dan Breezy, and today we have a fantastic guest, Gino Barbaro. Gino is a 3-time best-selling author with over 1,800 units of assets under management and has also helped guide his students to purchasing over 70,000 units. Welcome to the show, Gino. It's a pleasure to have you on with us today.
Dan, thanks for having me on, brother. How you doing?
Great. So maybe start with a little bit of background about yourself and what drew you to real estate. We were just chatting before we got on here, and you said you bought your guys' first multifamily deal in 2013. What were you doing before that?
Well, I refer to before that as life before Jake. Jake is my business partner, Stenziano, part of Jake and Gino. He's the drug rep. I'm the pizza guy. I own the restaurant for the majority of my adult life. I've been making payroll since 1994, and I had the restaurant for a long time. I mean, I eventually left in 2016, but when I met Jake in 2009 through the restaurant, that's when I knew I needed to make a shift because the Great Recession came. There was no jobs. I was working harder. I was making less, and I had 4 kids at the time. I've got 6 children now, but I needed to make some extra money, and I knew that fixing and flipping was not for me. I did not want to start and have another job. I didn't want to get a little golden goose and rinse and repeat and have nothing left over. I was already paying taxes through the restaurant. So I said to Jake, I said, I want to get into multifamily. I've made a couple of mistakes in real estate. I want to plant my flag on multifamily, and that's where we decided to start. In 2011, he moved down to Knoxville, which is a great market, and we started buying assets in 2013.
Wow, okay, so Knoxville, Tennessee.
Yep.
Okay, Knoxville, Tennessee, you guys are buying assets. What drew you to multifamily, or how did you learn how to go out and buy a 25-unit deal as your first deal?
I had purchased my first real estate deal back in 2002. It was a 3-unit. I had the restaurant. My mom owned the building. I was paying my mom rent. You know, millennials nowadays actually live in their mom's basements. Well, I was paying my mom rent for like 20 years. So I understood the concept of, hey, income, passive income. She had 3 apartments above the restaurant. Every month, those renters were paying her money. Whether I made money at the restaurant or I didn't, she was getting paid every single month. And for me, I didn't know what I didn't know. I was like everyone else. I was eager. When I got into that first deal, I did a mobile home park deal. I lost a ton of money. My second deal, I did a strip mall, lost a ton of money. And then eventually in 2008, I read that book by T. Harv Eker, The Secrets of the Millionaire Mind. And it was all about responsibility. It was all about, the actions that lead up to your life. And up until that life, the actions that I took got me to where I was. And I realized if I want to become good at something, I need to plant my flag and I need to get really serious about a specific niche. I had always liked rentals. I had always liked dealing with residents, and I liked that residual income. And I understood people needed a place to live. And I just decided in 2008, let me invest in my education. Back then, it was an expense. People think of investing in mentorships or educations as an expense, and you can look at it that way. But for me, I learned the framework. I learned the process. And soon after that, I was fortunate to meet Jake. He moved down to Knoxville, and it's like, all right, Jake, I know what I'm doing in the business. You don't. Let's partner up. Your boots on the ground. Let's figure that thing out together. And for me, just picking multifamily was just a niche. I could have gone into mobile home parks, but I had to learn it. And I think the problem nowadays is a lot of us have that get-there-itis. We have that shiny object syndrome where if something doesn't work, well, we're going to jump to something else. And we never become really expert at it. If you're selling and you're trading crypto, don't quit after 6 months if you don't have success. If that's what you want to be in, become a master at it. Put hours into it. All you need is 18 minutes a day. And by the end of the year, that famous meme says you're going to be better than 95% of this people on the planet. So choose a vehicle. Fortunately for me, multifamily is one of the best vehicles out there with tax benefits, with appreciation, with cash flow, with the basic human need. I just chose a really good vehicle, but then I had to be all in. I had to really get educated and understand how to buy that first deal and not have the scarcity mindset of going out and doing it by myself. Very few people in multifamily that grow and scale do it by themselves.
Yeah, man, that's good stuff, Gino. I hope you guys heard that. Takes bumps and bruises. That's how you learn anything. I look back in my life when you say that, Gino, I think about my snowboarding career. I was a professional snowboarder before being a real estate investor. And I just think about how much pain and setback we went through, or I went through, in order to actually become, a known rider. And the amount of stick-to-itiveness and pain you have to go through. I hear some people say you got to suck long enough to get good. And I think that's something that really needs to be heard by a younger population or younger generation in this world that's so instant. Nothing's instant. I mean, anything you work at, you're going to take a decade of sacrifice and absolute obsession to become something of stature in that field. So I'm glad you shared that. And I think something I've been reading more about Ray Dalio recently, and he's obviously a hedge fund guy that started with nothing, and he went through a lot of pain. And one of his biggest things, one of his principles is with learning from mistakes, is don't feel bad about the mistakes of those or of others. Love them. And the mistakes are the lessons, and there's a lot of people in real estate right now that I think are getting a lot of lessons. And this is that moment in time where if you learn the lessons and you make the changes and you implement new processes and you have new principles for investing, you have the chance to become amazing. You have the chance to become unique. You have the chance to become something that's actually, worth taking people's capital. How did you meet Jake? That would be a question I'm curious about, because it sounds like you had two lives, the life before Jake and then with Jake.
In 2009, he was a pharmaceutical rep. And he was coming to our restaurant and getting catering food and bringing it to doctors' offices and selling vaccines and selling pharmaceuticals. And what I liked about him, he was really one of the few pharmaceutical reps that would come in with a sheet and let me know, hey, I need an order Monday, January 15th. Can you get it ready for me? Really hardworking, young guy, had a lot of ethics, had a lot of integrity, and we created that relationship. So I had met him through the restaurant, and when he decided to leave New York in 2011, he's like, I want to get away from the weather. I want to get away from this tax burden. I want to get away from the quality of life. I thought he was crazy. I'm like, you're leaving New York? What's wrong with you, brother? And now that I look back, it's probably the best thing that he ever did, because he went down to the Southeast. He saw the migration before the migration. And Knoxville in 2011 was not what Knoxville is nowadays. And I was just fortunate that he went there and that I had the skill set of, okay, I know how to underwrite a deal. I know how to buy a deal. I know how to finance a deal. You're down in the market. Let's partner up and let's see how this thing works. And since that day one, we've been partners and we've been scaling and growing the portfolio together.
Gotcha. So you two are in this company together. What's the name of the company?
Well, the name of the education company is Jake and Gino, and the name of the investment company is Rand. Jake's a big Atlas Shrugged fan, so he calls everything with Rand. Whether it's some of our LLCs are named after some of the characters in Atlas Shrugged, so it's interesting.
Okay, and was it Rand or Rand?
Rand.
Rand. How do you spell that?
RAND.
Okay, cool. So in the company, do you guys have specific roles that this is you oversee, this is what Jake oversees, or how do you guys split that up?
In the beginning, it was let's do everything. I mean, our very first two deals, I'm up in New York and he's down in Knoxville. He's sending me up the bookkeeping. I'm doing all the bookkeeping, the record keeping. He's down on property. He's out there turning units. He's out there collecting rents. He's out there working with the resident managers, and I'm up doing the back end stuff. When we got to 200 units, it was like, okay, let's start hiring out. So we started hiring out property managers. We started getting maintenance techs, which really helped him out. And at that point, he was able to leave his job. And now it's morphed into, okay, Jake, you run the property management day to day. I'll run the education company day to day. And they sort of overlap. They sort of intersect daily, because the stuff that we're doing on the education side, if you go on jakeandgino.com, you'll see that we're interviewing tons of investors. We're interviewing thought leaders, people how to scale businesses. So the stuff that we learned from the education company, we've been able to implement in our property management company.
Got it. So let's talk a little bit about the education company. What is it specifically that you guys help, your students get educated on?
Well, there's a process, and that's what I was lacking with life before Jake. The process is I was all over the place. I didn't have a map. I always tell people, when you're going to go into a forest, do you want the map when you're in the forest, or do you want the map before you go into the forest? Well, before Jake, I didn't have that map at all. I was in the forest without a map. So our map is buy right, manage right, and finance right. That's our 3-step framework. That's the process we teach our students on buying a multifamily deal. Look at it from a 3-legged framework. And we call it Wheelbarrow Profits because a wheelbarrow's got 3 legs. It's got the back leg, which is buy right. It's got the finance right, other leg, and it's got the wheel, which is the manage right portion, which is in constant motion. If you don't execute on all 3 of those, if one of those is weak, guess what happens? Your wheelbarrow tips over and you're going to lose money, or the investment's not going to be profitable, or whatever happens. And you're seeing right now that finance right leg where you have $400 billion in assets where people thought they could get bridge debt, and it's not long-term fixed rate. They didn't finance their asset right. They may have bought it right. They may be executing right, but then all of a sudden their finance right is not performing, and what happens? Wheelbarrow tips over. And very same thing. You may have bought this asset right. You may have financed it right. But at Jake and Gino, we love to teach systems. We love to teach students on how to manage this asset. And a lot of operators have gotten into the business over the last 5 years thinking that they can go in, they can have the child. Great having a kid. You got to raise the kid. If you don't raise the kid, you're not going to make money. And they've just been fortunate over the last couple of years to ride the appreciation wave where cap rates are compressing and all of a sudden there's so much demand. Well, that's stopped. Now it's time to learn how to manage this asset. So if you don't execute on all 3 of those parts of the framework and one of them is faulty, you're going to be in trouble with that asset.
You couldn't agree more. I could not agree more. The opportunity you're seeing for buying now is the finance piece falling out on many owners. You've got people who have bridge loans that are coming due, and if they can't buy rate caps and kick the can down the road, they're in a place of having to sell, required to sell. And if you're required to sell in this market where liquidity is extremely dry, you're taking whatever you can get, and most of the time it's a huge loss. Maybe you could share a little bit, Gino, about your buy right. What are some of the top 3 or 4 things that you teach your students for our listeners if they're trying to become more educated in multifamily on when they're looking at deals or if they're looking at buying a deal? What would be a few things of buying right that you're teaching?
Before we get to the buy rate, what you said about finance rate is truly important. Those rate caps are so expensive right now. The whole idea is not to put yourself into a situation where you're buying debt that's not fixed. 2 years ago, there was euphoria. Everyone was rushing in, and they weren't buying properly because they were overpaying to begin with, and then they weren't financing properly. So this is a lesson for anybody getting into the business right now. Understand that if you're going to go that route and get short-term debt, there is a lot of risk on there. What we do is we use loan to cost. We'll go to a community bank or even a credit union on the front end if we have to, and we'll get at least a 5-year term. It gives us more time to work on that. And the problem was 2 years ago, it was very difficult to buy these deals, not on bridge debt. So what happened to us? We were buying smaller assets. We were buying 20-unit deals. We closed on a 40-unit, a 21-unit portfolio. But what happened was we just opted out. We weren't allowing ourselves to get into that risk, getting into that FOMO. And it's okay because when you look back, there was a 1-year period, 18 months, where it was challenging. But if we had made that mistake, we'd bought stuff on that bridge debt, we'd be in the same situation a lot of operators are in right now. So just be careful with that finance rate going forward. If you can get debt at 4.5% fixed for 10 years, you take that every day of the week. Now on the buy rate portion, it's really important when you're setting up your buy rate criteria. You can pick a market. Dan, when you're starting out in multifamily or in any niche of real estate, select one market. Become an expert in that one market. We picked Knoxville. We got to know all the brokers. We got to know the neighborhoods. From there, start creating the relationships with those brokers because the brokers are the gatekeepers. They just are the gatekeepers. Start going to events. Start going to meetups. Then from there, you're going to have to start creating what we call your buy rate criteria. You need to have a criteria. And I'm amazed. I've been to a lot of events. I ask a lot of people this question, a lot of syndicators, what's your criteria? They look at me like a deer in headlights. They don't even know what I'm talking about. I'm like, well, what are you buying? Well, I'm buying a deal. And a lot of students, when they first join, I'm looking for deals. A deal for Dan is not the same thing as a deal for Gino. You need to be crystal clear on what you're targeting. Let's start with the market itself, the submarket. Let's talk about median income of the area. What are you targeting? Do you want $40,000 median income? Do you want $80,000 median income? The age of the asset. Do you want an older asset? Do you want a newer asset? What kind of unit mixes? Do you want 2 bedrooms? Do you want 3 bedrooms? Do you want garden? Do you want townhomes? Do you want assets that are pitched roof, or flat roof? Do you want assets that have brick, vinyl siding? Do you want assets that have amenities, washer, dryer hookups? This is really important because you're starting to paint a picture of what you're looking for. And so when you're doing your buy right criteria, you need to understand where you are in the market cycle, but you need to understand also your parameters. Can you buy 10 units? Can you buy 50 units? Getting crystal clear on that will give you an idea when a deal comes across your desk. 50s build, cast iron, it's all studios, it's flat roofs. I don't even want to take a look at it. I mean, it gives you the ability to focus. And once you're clear on something, man, you don't lack motivation. You lack the clarity. Once you have the clarity of what you're looking for, it's a lot easier to start selecting deals. And also, when you're talking to brokers and conveying to brokers what you're looking for, when they find something like that, they're going to think of Dan or Jake and Gino and say, this deal's for them. Let me call them up. I'm going to send them this deal.
Yeah, I'd say another point just to add to all that, Gino, is that as you go, you may not know what criteria fits your criteria or why you're picking criteria. So that's where hiring somebody or getting with an experienced group to really help you hone in on criteria, that is so critical because, you might not understand why you would want to be in a 50K median income versus a 30K.
That's right.
What does that mean? So if you don't know what these things mean, you're going to have a really hard time developing your criteria.
That's a great point. And the other thing is you got to start with yourself. There's a little bit of coaching going on by saying, hey, Dan, what are your goals? Are your goals to leave real estate, leave your job in 3 to 5 years and going through multifamily full-time? Or are you looking to do this on a passive side, or you're just trying to build retirement income? Well, those are two different strategies. Do you want to invest in a market that has high cap rates where you might get a little more cash flow? Or do you want to, invest in markets that have low caps and you're looking for value to add value and you want appreciation? I can't answer those questions for the listeners, but these are the questions you need to ask yourself. And every market has different buy right criteria. If I want new assets in Jacksonville, I'm not going to find any assets in Jacksonville built in the 80s or 90s. There's very few. But you have to understand the market, and then you have to understand your goals and what you're trying to accomplish. And then from there, you're going to start figuring out what your buy right criteria is. But you make a great point. A lot of these things we didn't know. We had to learn as we went along, and that's how the education helped us out. It gave us the clarity on saying, we're already investing in mom and pops. We're already buying these assets. Well, buy right, manage right, finance right. Mom and pops, the market, how do you start syndicating deals, how you start raising capital, how you start seller financing. That's all encapsulated within the framework. But if you don't have those pillars, you're just going out there and your risk is going to be a lot higher because you're not able to follow a plan or a methodology to be able to, buy these deals and find these deals.
Yeah, definitely. I think those are valid points, you guys. Definitely worth getting. I mean, when you hear Gino talking, and I can hear as you're probably listening, it sounds complicated. Well, it can be until you get clear.
If a pizza guy and a drug rep can do it, I don't mean to interrupt you, Dan, but real quick, I'm a pizza guy. Jake is a drug rep. It's only confusing if you don't take the time to educate yourself and to create a plan and to really surround yourself with other people who are doing it. A lot of us say to ourselves, well, Dan's doing it and Gino's doing it. I can't do it. That's nonsense. It's you think you can't do it, and then there's the fear, and then the fear just holds you back or locks you up. I think what people need to do is really need to look around and see who else is doing it and then pull the curtain back and go, well, he was just a pizza guy 10 years ago, and it's not that difficult. It's real estate comes down to really running a business. That's what I think people don't understand. And if you can understand systems and running a business, income over expenses, I mean, it really starts to take care of itself. And thinking of yourself as an entrepreneur to run this business, it's the best business on the planet. You're making an investment and you're able to run a business alongside your investment. I mean, what better business in the world than that?
Yeah, well, let's move to managing right. What are some of the key characteristics of managing right that you're teaching your students?
I mean, there's so many different levels of manage right. If you talk really about the cadence of accountability, what we talk about when you have your level 10 meetings, which is part of traction, if you're managing the manager and you're hiring third-party property management, you need to set expectations. You need to have rhythms with them weekly. We have things called property logs where we're filling out logs for every single property. We have something called a weekly pulse where every week we're sending out documentation and numbers to our property managers. So this is an internal document for us. But if Dan, you have a 50-unit property, I want to see a weekly pulse every week from that property manager saying, what are our delinquencies? What are our vacant rented? Where are we with, lease expirations? Where are we with people breaking leases? That weekly pulse is going to give you a snapshot of the property weekly. And I think you need to become the asset manager. You're managing that asset. And if you're doing it as part of, yourself, fine. But if you're managing the manager, you need to have these touch points and understanding how to hold third party accountable, how to hire third party accountable. Then you have all of the different systems, the move-in systems, the turn the unit systems. You're talking about all the different KPIs. We set up KPIs for our students. It can be daunting at first, but once you've done one deal and you have it set down, it's just a rinse and repeat kind of thing.
Mm-hmm. And just catching you guys up, KPIs would be key performance indicators. We're in the same boat, a weekly pulse of occupancy, how many walk-ins we had, how many leases, how much delinquency. It'll be your guide of which way the asset's going. What's your trend today, your occupancy? What's your 30-day? What's your 60-day trend? It'll help you understand your marketing, where you're weak. And the manage right piece, I couldn't agree more. You've got a lot of people that get into this business because it's exciting to buy and then forget or don't realize that it is a process and it is a challenge to manage right. It takes time and it takes knowledge and it takes the right leadership. Anything else you'd want to add to about the management piece before we kind of move on to financing, right? What you would call?
I'm trying to think if there's anything else that would be glaring. For us, if you can't measure it, then you can't manage it. I mean, think about always trying to be proactive instead of reactive. I think the other thing with manage right, don't be cheap. Get property management software. Jake and I are at 500 units, and we're using a company called RentPost, the biggest piece of crap that you could possibly imagine. And we decided at that point, well, Appfolio is a couple dollars per unit, and we were really cheap. And when we moved on to Appfolio, everything changed, because if you have the numbers in front of you and you're seeing it and you're being proactive, if you're on week 2 and you've got $3,000 in delinquencies, well, why is that? Let's be proactive. Let's send out texts, or let's send out emails. Let's try collecting that money. I think being proactive is important, and being able to manage and measure those numbers is important. Pick out what key performance indicators are important to your company. I like what you said, guest cards versus applications. How many people are visiting it versus how many applications you're getting, and how many are you turning. We also like renewals. Get out your 60-day renewals and be proactive on renewals, because if you can renew the people in your apartments, in your homes, that will save you a ton of money, a ton of time, ton of turnover, and a ton of money. So make sure you have a system for renewals.
Yeah, and going back to if you can't measure it, you can't manage. I think a piece to add to that triggered is hire A players, and you've got an A player when you measure them, because A players love to be measured, because A players know, hey, they're going to be watching and I'm going to succeed, and when they measure, there's going to be a pat on the back. So keep that in mind as you're hiring team members. And this is the most pivotal piece we've seen firsthand on our assets is when you have an A player, manager, on-site, regional, you're going to see that deal perform far beyond what you probably be able to do on your own.
I agree.
Yeah. Financing, right. Let's talk a little bit about that. So you gave a little bit of a hint saying, if you can't use bridge, let's go to regional bank, get a 5-year runway. Maybe, for folks who didn't understand that, what do you mean?
People love bridge. They love agency because it's non-recourse debt. And I get it, because you're signing on the debt. You're not personally guaranteeing it. Community and credit has recourse debt. There's risks to it. You're personally guaranteeing it. When Jake and I started, we had nothing anyway. So what were we guaranteeing? There is risk. There's risk in business. But even if you quote unquote crap out on an agency loan, you're probably not going to be doing business for a while with them. So for us, we just started out with the community banks and the credit unions on our very first go around in 2013. We were fortunate that we were able to refinance back with that community bank on the first go around, and then the second go around, we would take it to agency, a Fannie or a Freddie product. And for us, working with community banks starting out was just easier. It was a lot less challenging. Now, Freddie's come along in the last 10 years or so. They weren't around when we started. It wasn't a big program, but Freddie's allowed newer investors to actually get into the market right now. But now you see what's going on with the financing. You'll know that when we have a problem in the economy or in real estate, debt is the problem. Debt is the circulatory engine of the economy. And 18 months ago, 2 years ago, you saw LTVs dropping from 75, 80% down to 70%, down to 65, down to 60%. And that was the first signal saying, wow, you know what? There's a lot of risk. They don't like these valuations. They want these operators to have more skin in the game. Just be careful with bridge debt because it is super expensive. And it is really difficult when you're trying to refinance out. You really need to read the fine print. The fine print is so amazing. And they're, how can I say it nicely? Banking likes to take advantage. And when they put stuff in, when you have to refinance with them and give them the right of first refusal, are you going to get great terms? Not really. You're going to have to fight tooth and nail to actually get out and try to get something decent on the back end. So just be aware of bridge debt, how expensive it is on the front end. And when your exit comes, it's very difficult to out and refinance it. Obviously you can, but it's expensive refining it out as well. So make sure that's in your plan. All of those different costs. Working with a credit union has been amazing. I mean, their origination fee is a couple $1,000. They're not a bank. I mean, they're so easy to work with. They look at your balance sheet. They look at the asset. And there's just a pleasure to work with. Now, obviously, you're personally guaranteeing it, so there's the rub. But with them, I mean, we're doing a deal with them right now. It's 6 3/4, 2 years of interest only. There's a 5-year term that the rate is locked. By year 2, by year 3, we're going to refinance out of that deal. So it's one of those things where just be open to community banks and be open to credit unions because right now the credit union is actually giving us really favorable deals, really favorable terms.
Question for you on the credit unions are usually 5 years fixed. And you said interest rate of 6.75% right now?
Yep. Yeah, exactly. And it's 2-year IO. So, I mean, that's phenomenal. And sometimes they'll go to 25-year AMs and some credit unions will go 10 years fixed. I mean, it really depends. Some credit unions go to 30-year AMs. I mean, that's free. 30-year AM. I mean, you got a 10-year fixed and sometimes they throw in 2 years of interest only. That's phenomenal, dude.
Mm-hmm. Definitely. I like that. I like that play. You maybe don't want to go with a bridge loan because you don't have control of your rate unless you're going to buy a very expensive rate cap up front. I mean, if you're buying a bridge loan right now and you want to have a 5-year runway, you better buy a rate cap that is going to be millions of dollars. So, you're not going to go that avenue. I do love credit unions. They are very easy to work with. They've been great for us as well. So I appreciate you sharing that. Kind of shifting it for the last 5 minutes of our conversation. Where do you predict the market goes from here? Where do you think interest rates go from here? How much higher do you think the Fed pushes? Or do you think we're starting to kind of get to the peak and we start to flatline? Or what do you think the next 12 months looks like?
There's going to be a lot of blood in the streets. There's a lot of operators that are really holding on too long and their rate caps have expired and their debt's going up and it's so expensive to get those rate caps. And we see deals in Knoxville, in our market of Knoxville, coming on thousands of units, and they're just sitting there, and the pricing there is insane. I mean, you can't buy these assets at 170 a door, and interest rates are 7%. And I think in the next, I was reading a stat, $400 billion, I think, in debt maturing this year. I think $500 billion next year. There's a lot of debt that's maturing, and if these banks don't have the liquidity to work with these operators, they're going to have to sell. They're going to have to sell at a loss. And a lot of these operators, it's no fault of their own. I just hope people who are in good markets, they may fare a little bit better because you still have migration. So if you're in the Southeast, you're in Florida, in Tennessee, where we are, in the Carolinas, you're still having people come in. So there's still demand for apartments. But if you're in a market where people are leaving and you're having all of this happening right now, it may be difficult for you to exit that deal, or it may be difficult for you to continue to get those rents where they are right now.
So are you guys buyers over the next 12 months with blood in the streets?
Absolutely. I mean, we've closed we're closing our third deal this year in 2 weeks, and we see there's a ton of opportunity. We absolutely see there's a ton of opportunity, and there's a lot of people leaving the market right now. It's the same thing as what happened in 2010, 2011, when people should be entering. They're all exiting the market right now.
Couldn't agree more. I think these next 12 months, for those that know what they're doing, and for those that have a track record of performance, you will see the educated and sophisticated groups come in and buy as much as possible, and even potentially these next 24 months. If you're an investor and you've been sitting on the sidelines, you might want to start looking at deals, get to know the general partners at a deep level. If you don't know them, get to dinners with them. Get to know them. You get referrals. Talk to other investors who have been in their deals, and get to know their underwriting. Get to know their value add plan. Get to know their track record, and then you can actually start to come in a time when prices pulled back 20, 30%. get in with this low leverage fixed debt and ride the next wave as prices go up.
Exactly.
So,
Perfect.
yeah, anything else you want to add before we wrap it up?
I would just say go out there and start networking. And this is the time of the market where you're going to look for deals. There's always two things you can do in real estate. You can either source capital or source deals. You need to be doing both at the same time. If you hadn't been finding deals over the last 2 years, maybe it was time to start creating those relationships with your investors. Now is the time to get into real estate. Start creating relationships with brokers. Start learning a process, whether it's buy right, manage right, finance right, whatever the process looks like to you. And start networking. Start going out there and meeting the brokers, because now brokers are going to call you back. A year ago, brokers weren't calling you back. They didn't need you. Things change so quick and the opportunities are here, but they're only going to be here for the people who are actually in the market doing deals and going out to these events and meeting other people in the business.
Gino, thanks so much for coming on the show. If someone wants to get a hold of you, how would they go about doing that?
Just go to jakeandgino.com. We've got our weekly podcast that air. We've got books. We've got content. We've got the coaching program. If you want to learn more about the coaching program, just go to jakeandgino.com/apply.
Thank you for joining us on another episode of the Keeping It Real Estate Show. Again, my name's Dan Breezy. Please leave a 5-star review for us or refer this episode to others, and we'll see you next week. Thanks, Gino.
Thanks, Dan.